You clicked on this video because you've come across fair value gaps, or you've probably been seeing fair value gaps on your social media timelines or your For You pages or whatever, on your YouTube feed, and you ask yourself, or curiosity spikes, and you're like, what really is this fair value gap? How do I get to know what fair value gap is? And then you have been researching and you found this video. Now, if this is you, today's video, I'm going to be taking you through what a fair value gap is, fair value gaps formation, high probability fair value gaps, and as well as how I use fair value gaps to trade and how you could also apply it. So without further ado, let's get straight into the main game. So what really is a fair value gap? A fair value gap is usually a space that is created in price due to imbalance between buyers and sellers, and this space usually happens when there's a swift move to either the upside or the downside. Okay, when there's a swift move to the upside, it's called a buy side fair value gap, and there's a swift move or a fast move to the downside, it's called a sell side fair value gap. Let me give you a real life illustration of how the fair value gap really occurs. Now let's say that this box is given to you to color, not just to color now, but to color as fast as possible, and then you quickly start to shade it very fast. You're trying to shade this very fast. Now something is going to happen. You're going to leave these spaces which you'd have to come back to recolor. Let's say we're coloring children. When children are coloring, or anybody that is, or a painter is rushing to paint the house, and then he rolls the paint very quickly. When he rolls the paint brush very quickly, there will definitely be bubbles that would not be painted, or there'll be holes or parts of the wall that will not be painted that he needs to revisit. So when the market creates this space or this gap, it needs to come back and revisit this gap. That's just the concept of fair value gaps. If traders can understand that, okay, when these fair value gaps are created, the market comes back to revisit it. Now, what does that tell you? Okay, we could trade towards the fair value gap or away from the fair value gap. Okay, now let's go to fair value gap formation. So a fair value gap is formed with 3 candles. Okay, and now those 3 candles, just like what you've seen on my screen here, now you see that normally it is normal for each side of every candle in the market to be covered by wicks or bodies. Meaning, if this is a single candle like this, if this is a single candle now, it must be covered. Both sides, both the right and the left, must be covered with either the wicks or the bodies of other candles. That is when you have a proper market move, okay, and there's a proper balance between buyers and sellers. But then when you now have very swift move to the downside or very swift move to the upside like this, now, and a gap is created, the market usually find its way back here. The market usually finds its way to come back and fill this up before going back down, right? It happens all the time. So now, how can you identify that, okay, this is a fair value gap? And there are basic things to take note of. It's usually a 3 candle formation. So let's say this is candle 1, 2, 3. So let's say this is candle 1, then this is candle 2, and this is candle 3. All right, so if you have candle 1, 2, 3, just like this, the gap is usually on candle 2, whereby you draw out the low. If it's a sell side, you draw out the low of candle 1 and the high of candle 3. If it's a buy side, you draw out the high of candle 1 and then the low of candle 3. You don't need to cram this that, okay, we're going to take the high and the low of this. No. When you have a 3 candle formation like this that quickly moves to the downside or quickly goes to the upside, now there's always going to be that part of the candle that the body or wicks of the previous and the next candle did not cover. So when you have that, you just know that, okay, this is a fair value gap that the markets could either come into and go the intended direction or just fill and keep going up. Now for the buy scenario, similar thing. For the buy scenario, you have the markets move to the upside, okay, swiftly. Well, if these are actually real markets and you have like this break and prices, this breakout of this level here, and prices going upward very swiftly, you'd notice, even aside this one we drew here, there's still a small gap between this candle and this one. Okay, there's still a small gap there. But then the major one that we're looking at is this major big fair value gap where you have the space between this high and the low of this candle. Right, you have a fair value gap here. Now, high probability fair value gaps. Let's go to the chart and let me show you something about fair value gaps and high probability fair value gaps. Now, when you have the markets distribute in patterns like this, the market distributes in higher highs and higher lows like this, right? Now, you can have fair value gaps situated everywhere. You can have a fair value gap here. Okay, you could have a fair value gap here, you could have a fair value gap here, you could have a fair value gap here too, and as many places as possible. So how do you now know which? Just like if we had fair value gaps like this now, had a fair value gap here, and this one here, and multiple other ones, which one actually would move price? If you've been in the market for quite some time, you'd know that when price moves, it retraces to at least 50%. So let's say we pick our fib from the low to the high, since it's a buy scenario, the market should come to at least 50%. This was drawn manually, randomly, right? Now, price retracing to at least 50% tells you that the market is not going to take off from here. The market is not going to take off from here. The market is not going to take off from here. Most times, if it does, it's coming back down, and then this is going to be a potential liquidity. All right. So if you understand this, now you know that the high probability fair value gaps are usually the ones within the 50% or below, which is your discount, right? Discount prices. Okay, you're looking at the discount zone of your fair value gap. If you want to have your fair value gap like mine, I'll just give you the settings for the fair value gap so that you could actually have your fair value gap like mine if it suits you. So let me just quickly do that so you could take a screenshot and have yours just like mine. All right, so these are the settings for my fair value gap. Okay, these are the settings for my fair value gap. You can take a screenshot as quickly as possible. You don't need to stress yourself. This is the settings for my fair value gap to have yours just like mine. So for the sell side scenario, let's say we have price delivering to the downside like this. Okay, now in this particular swing, we're going to draw from the high to the low. Okay, now you're looking out for only fair value gaps within this region, within the 50 and above. This is where you're looking out for fair value gaps. All right, so anything that is here, don't take it because it's low probability. If you're working with something, make sure you're working with what you know that, okay, I'm sure that this works. Okay, now let me do a couple examples on the real chart, and so that you just get to see them for yourself. Now look at this here. We have a break to the upside, right? We have a break to the upside. Now, if we are taking our fib, and we take our fib from the low, okay, from the low to the high, all the way to the high, this fair value gap that is here falls within the 50%, so we can take it from here. Okay, we can consider that this fair value gap works. If this is the only fair value gap, and let's say it's like this, or how do I draw this now to make it understand? Okay, good. If this is the only fair value gap and it's like this, you rather just go for the order block. Don't use the fair value gap to trade if it doesn't fall within the 50% range. All right, so how I use fair value gaps, it's very simple. On higher time frames, I use fair value gaps to know direction of the market. So if I come to the market and I make price in the fair value gap, I'm looking forward to trade away from the fair value gap, all right, and towards the intended direction of the market. Then on the lower time frames, I use fair value gaps for my entries. So if I have a break of market structure to the downside, just like this, if I have a break of market structure to the downside, this is a break. Now I'm looking forward to fair value gaps like this here, and I want to see price come into it and sell. That's just it. Okay, but on the higher time frames, if I have a fair value gap on the higher time frames, what I'm looking forward to doing on the higher time frames is, let's say this is a big move, fair value gap is here. All right, on these higher time frames, I want to see price reaction on lower time frames and trade away, probably towards liquidity below here. It's just that simple. Okay, then on lower time frames, I just show you how I treat it. I have to see a market structure shift, right, and then trade towards direction of external liquidity or whatever my target is, and that is just it. If you want to backtest, a very good tool I use to backtest, which I'd recommend to you, is Traders Casa. With Traders Casa, you can go back in time and backtest as much as you want. If you want to see how I trade, you want to follow my trade calls, you do well to click the link in the description. I'm going to be dropping a link to my free Telegram community where you could be able to follow my trades and my markups. I'll also drop a link to Traders Casa down below, so if you want to backtest, you can backtest with Traders Casa. All right, until next time, be safe.